Evelina, this year we've seen a tremendous rally in bond and stock markets, but it hasn't really lifted up all boats. The distressed market has severely lagged. In your opinion, what are investors waiting for before jumping in?
I think that investors have already jumped in to a large extent. What I think is important to highlight when you think about distressed opportunities and when you think about divergence is how distressed investors ultimately underwrite risk and how they think about risk. When we think about risk on an illiquid basis, on a 3-year basis. And what that means right now in the cycle is that we're going to be owning a lot of these companies potentially through a recession. So what we really are waiting for is an opportunity to buy it cheap to that 3-year forward, right? So that is your litmus test in terms of where is the distressed money going to come in. And ultimately, I think that speaks to where is the market ultimately going to price some of these names. Because you hear about, distressed money coming into the market, a wall of distress being raised for this opportunity. But until we actually are cheap enough to, again, like that 3-year long-term forward, I don't think you're going to see that much participation.
So basically, the market is waiting for some sort of dislocation that properly prices those assets.
Yeah, I think that the go-go markets are still at, multi-year highs. So again, until we actually see performance and, these assets actually pricing to that long-term, forward or cheap to that long-term forward, you're just not going to see that much participation.
So you obviously have to figure out where to put your money in a time like this and look for opportunities, even where the parts in the market are properly priced for you and attractive to you.
Yep.
So where are you finding opportunities in this wait and see mode?
So, I think that there are the 3 things that you need to be looking for in a late cycle market such as this. First thing is you need to be looking for idiosyncratic opportunities. So even though a sector has come under a lot of pressure, a specific company is actually presenting a unique opportunity that is going to allow you to extract value no matter to what's happening to the market. So idiosyncratic opportunities first and foremost. Event opportunities second of all, i.e. somewhere where you can either create an event or you can be put into an event that is going to effectively allow you to crystallize value. And third of all, again, like cyclical opportunities where you in fact are creating something cheap to the long-term forward and you're creating it cheap to trough in a recession. So these are the 3 things that I think late cycle ultimately make money.
Is there an example of something in particular?
I would say that, again, litigation, liquidation risk is definitely interesting in this type of market because it's not that cyclical, it's not that correlated. Just in terms of, opportunities which I think cyclically are cheap. I know that's a controversial thing to say, but you know what? I actually do think oil and gas is actually pretty interesting in this type of market. There are a lot of projects, a lot of companies which you are creating cheap to, PV15, PV20. So even if you adjust that for, SG&A, which has been obviously the topic du jour over the past 12 months, you're just creating some of these projects to MPV in the low teens, which is very, very attractive.
And that would be both in the U.S. and outside of the U.S. that you'd be looking into the energy sector?
Yes. I think that the opportunity is more pronounced in the U.S. because some of the post-reorg equities in the energy sector, have gotten completely destroyed this year, right? We're talking about divergence in performance in credit market, but if you actually look at some of these post-reorg equities, they're down 75-80%. For example, a company like Seadrill, we're not invested in Seadrill, but a company like Seadrill is, down 80% year to date. And guess what? We're talking about offshore here. You're talking about buying drill ships very frequently, 7th-generation shallow water drill ships inside of 9100, and these are drill ships which were actually built at 250, 260 million. So there is definitely value there. You just need to have patient capital, and you need to, I think, realize that you might be in that trade, in that investment for a prolonged period of time.
Because one of the things that's keeping investors away from jumping into energy at this point was that they got burned pretty bad a couple years ago.
Absolutely.
So how do you ensure that you're buying actually good assets? What specifically do you look for?
So when you think about, I totally agree with you in terms of sentiment. I think sentiment is definitely at multi-year lows. And I think that the reason is when you actually were looking back in 2016 at oil and gas assets, oil was significantly lower, but I think there wasn't that much fatigue in terms of some of these investments. Fast forward several years, there is so much fatigue. And even though oil has been pretty range-bound, some of these investments have ultimately lagged. So what we're looking for in assets is we're looking at operating assets. So again, like we're talking about offshore, like when you talk about offshore, you're looking at, ships which are under contract, which are not stacked. So they're operating through a cycle and ultimately generating cash until you actually have an opportunity to monetize the asset. So we are looking at cash flow generation, which can effectively bridge you from the current values to hopefully where you're going to be selling it in 3-4 years' time.
And you and I were speaking earlier, you've done a lot of work looking at PG&E. Could you just tell us a little bit about your thoughts in terms of the fight between creditors and shareholders right now, and who's probably more threatened out of the two sides from the current wildfires in California?
Yeah, absolutely. So just for disclosure purposes, we're not involved in PG&E. We have spent a lot of time looking at PG&E. And I have to tell you, I understand both camps, and I understand why they are excited about being involved in this asset. Because I have to tell you, as a distressed investor, it is actually pretty rare that you manage to buy a utility company in an oligopolistic market inside of 8 times EV to EBITDA, right? And this is what's happening here. So obviously both groups are interested in owning this asset. What I would say is that, in my opinion, there is plenty of value here to go around, and an amicable solution which benefits all parties and allows all parties to recover significantly higher than where they're invested should be possible. And I think that that's what should be pursued over the next couple of months.
And we have also this a lot of drama going around right now with Brexit, obviously.
Yep.
CQS is London-based, and of course that means you're following that drama pretty closely. Are there any opportunities there to make money for a distressed investor?
Yeah, no, absolutely. It's funny because when people talk about Brexit, they always talk about, hard Brexit and how are companies going to react to hard Brexit. Well, let me tell you, it is already happening, right? Like we have lived with that uncertainty for 3 years. What does that mean for companies? What does that mean for corporates? Hiring and firing decisions, expansion decisions, CapEx decisions, all of that has been on hold. And obviously you're seeing like a significant slowdown across a number of industries. I mean, consumer discretionary just on the back of lower consumer spending, commercial real estate on the back of weakness in retail. That ultimately feeds into banks. You're talking about casual dining is coming under pressure. Food producers and processors are coming under pressure. Supermarkets are coming under pressure. So yes, there is a lot of, I think, stress in the system. And in turn, I think that there are a lot of interesting opportunities in terms of good companies, wrong balance sheets, cyclical pressure. If you can get involved and you can bridge this company through a cycle, you're going to be creating them at some very, very interesting levels. We're definitely involved in some of these companies. Examples are, again, names where we are involved on the long side. We're involved in a retailer called New Look, which we recently restructured. We are involved in a food processor called Buparan. And again, like both of these instances, I think are example of a good company that is coming under a lot of liquidity pressure and has most probably the wrong type of balance sheet, but ultimately offers value.
And basically the outcome of Brexit won't determine the fate of those companies one way or another?
I don't think so. I mean, I think that these companies have a reason to exist. I think that ultimately a hard Brexit would obviously hurt them, because what you have to remember about a lot of these businesses is sales are in sterling in many instances, but their input cost can be in dollars or euros. So obviously, if sterling goes to 1, these companies are going to come under pressure. But there's obviously a way to hedge that. FX is obviously pretty liquid. So in terms of the companies that we own, we are very hands-on in terms of planning for that type of, contingency, so we can protect our downside.
And just, is there, we talked a little bit about some of the expected shakeup that the credit cycle is going to be experiencing. Is there a particular part or area of credit that's most primed for a crisis, in your opinion?
Public markets, public high-yield markets. The public high-yield markets in Europe and the US have grown to the tune of 2.5x over the past 8, 9, 10 years. And I think what has happened alongside this growth is we have seen the rise of ETFs, which I think has introduced a lot of liquidity mismatch in the system, i.e. funds which are buying some of these high-yield bond deals, which are shaky, right? And they're buying them in big clips. So when actually, cycle turns and they're forced out of these positions, what you're going to see is a lot of pressure, obviously, in terms of prices. And then the second important element, I think, is regulation, banks' balance sheets. Dealers simply cannot own that much inventory. So the natural mechanism, i.e. the guy that was supposed to provide a bid, is no longer there. So what you're going to see is a lot of situations where some of these assets air pocket. So they go from trading at 85 to trading at 35 with nobody stepping in. Right. Because back to the stress, guys, the litmus test is we usually are 30 points back. Right. And the reason we're 30 points back is because we're going to own it over the next 3-4 years. And again, like our investment philosophy is very, very different. It's a long-term philosophy. And again, very frequently that requires us to buy it lower.
Ivelina, thank you so much for joining us.